Very good morning to all. I am Papuri Bora. Today, I am going to give my presentation on the basic concepts of income tax, which is a part of personal finance subject of the BCom third semester course. So, coming to the introduction, my presentation will include the concepts of heads of income, meaning of person and SSC, what are the different types of SSC, meaning of gross total income, and taxable income, meaning of assessment year, previous year, and meaning of exemptions and deductions. So first of all, what is the meaning of tax? A tax may be defined as a compulsory extraction made by the central government from the general public. It is a financial charge imposed on individuals or legal entities by the government in pursuant to its legislative authority. A tax is not a voluntary payment or donation, but an enforced contribution exacted pursuant to the legislative authority. After clearing the meaning of tax, what is income tax? Income tax is one of the direct tax in India. It is paid directly by the SSC. There is no intermediary in between paying income tax. So how income tax came in India? What is the history of income tax in India? So in 1816, the British rulers introduced income tax for the first time in India, followed by the mutiny, Sepoy Mutiny in 1857. After that, a lot of experiments took place between the period of 1860 and 1886. After the experiments, finally, in the year 1886, the first Income Tax Act came into existence. Again, this 1886 Income Tax Act was replaced in the year 1918. But this 19 Income Tax Act is very short-lived and it was again replaced by the Income Tax Act 1922. Again, the 1922 Income Tax Act ran for a very long time and finally it came to an end on 31st March 1961, and from then onwards, the Income Tax 1961 is going on by every year with modifications. Now, who is liable to tax under Income Tax Act? In this connection, liable to tax in relation to a person with reference to a country means there is an income tax liability on such person under the law of that country for that time being in force and shall include a person who has subsequently been exempted from such liability under the law of that country. So now, what is the meaning of a person under Income Tax Act? In section 231, subsection 31, the meaning of person is given under Income Tax Act 1961. So, under this act, person includes an individual. An individual refers to a natural human being, whether male or female, minor or major. It is a natural human being. Second one is a Hindu undivided family. Hindu undivided family means it is a relationship created due to operation of Hindu law. The manager of HUF is known as Karta and other members of the family are known as co-personers. The third one is a company. What is a company? A company, we all know that it is an artificial person registered under Indian Companies Act 1956 or any other law. But 1956 Companies Act is now replaced by Companies Act 2013. Next one is a firm. Firm is an entity which comes into existence as a result of partnership agreement between partners to share profits of the business carried on by all or any one of them. Then fifth one is association of persons or body of individuals. Association of persons doesn't only include individuals, but in case of body of individuals, it includes only individuals. For example, in association of persons, we can include cooperative societies, Markfeed, etc. But In case of body of individuals, only individuals are included. Other than individuals, there is no scope to form a body of individuals. Whether it is an association of person or body of individual is a question of fact and to be decided in each case separately. Sixth one is a local authority. Local authority, for example, we can say any municipal authority, any panchayat, any port trust, etc. And last one is artificial judicial person, which are not covered in the above 6 clauses. Any artificial judicial person which is established under special act of legislature can be categorized under this category. So, in Income Tax Act, we cannot say a natural human being is only a person, but these all 7 categories are included in Income Tax Act as a person. Okay. Now, what is an SSC? In an Income Tax Act, the SSS definition is given under Section 2, subsection 7. SSC means a person by whom any tax or any other sum of money is payable under this Act. And it includes every person in respect of whom any proceedings under this Act have been taken for the assessment of his income or the income of any other person, in respect of which he is assessable, or loss sustained by him or such other person, or the amount of refund due to him or such other person. And it also includes every person who is deemed to be an assessee under the provisions of this Act, and every person who is deemed to be an assessee in default under this provision of this Act. So mainly if we see, then assessee are of 3 types. First one is ordinary assessee, second one is representative assessee or deemed assessee, and third one is assessee in default. Now, who is an ordinary assessee? Ordinary assessee is a person against whom some proceedings under this Act are going on. It is immaterial whether any tax or other amount is payable by him or not. Such type of assessee is known as ordinary assessee. Representative assessee or deemed assessee is who? For example, we can say the guardian of a minor or a lunatic. In case of a minor or lunatic, the guardian will be the representative assessee. And for example, if there is an agent for a non-resident Indian, then that agent will be treated as a deemed assessee for that NRI. So, representative assessee and deemed assessee are also considered as an assessee in India. And last one is assessee in default. For this, I would like to take my own example. I am an employer of JDSC College. So, in my case, I am the employee and JDSC College is my employer. So in my case, what happens? JDSC College deduct my tax and he pays the tax. So JDSC College is the institutions where I am employed. So in my case, if JDSC College deduct my tax every month or every quarter and fails to pay or fails to deposit the same into the government, then the assessee in default will be JDSC College, not myself. Okay, so these are the different types of assessee which comes under Income Tax Act in India. So the next concepts are exemption and deductions. Actually, in India, we are very much privileged to claim this exemption or deductions. Actually, exemption is not claimed, exemption is totally exempted, and deductions we can claim. So, what is exemption and deduction? Exemption means are those incomes which are exempted under Income Tax Act. That means it does not form any part of the assessor's total income. It is only an income, but in that income we need not have to pay any amount of tax. It is not included in the assessor's total income. On the other hand, what is deduction? Deductions are some of the investments we can say in different avenues. If we have invested an amount, then Income Tax Act has given us some deductions that we can claim. For example, if we have invested in Sukanya Samriddhi account, or if we have purchased NSC or National Savings Scheme, or if we have invested in recognized provident fund or statutory provident fund, anything. If we have invested our amount in some avenues and Income Tax Act has given to claim deductions regarding those investments, then those we can claim and minimize our taxable income. That means it will be included in our total income, but by claiming deductions, we can minimize the taxable income. On the other hand, exemptions, those incomes which are not at all included in the total income of an assessee. So this is the difference. Got it? So after knowing what is assessee, what is person, now here comes the heads of the income. So in Income Tax Act in India, the heads has been classified under 5 heads. So first one is income from salaries. Like I am employed in JDSC College, so JDSC College pays me salary. Then second one is income from house property. Suppose a person have 3 to 4 houses and he has given one house to let out for tenant. Then the income come from that source is categorized under income from house property. Then profits and gains from business or profession, we can say all the dish shops, grocery shops or clothes shops or anything else profession if we consider, then we can include CA, doctor, CS. So the income or gains from that type of business or professions are included in this type of head, that is profits and gains of business or profession. Then next one is capital gains. So capital gains includes suppose we have sale land, or suppose we have sold some shares or stocks in the stock market, then the income generated from such type of incomes are categorized under this head, that is capital gains. And last one is income from other sources. Income from other sources means if we cannot categorize in any of the previous 4 heads, that is income from salary, income from house property, profits and gains from business or profession, or capital gain, then such type of incomes are categorized in income from other sources. For example, if a person wins lottery of rupees 5 lakhs or 10 lakhs, then that is an income which is covered under income from other sources. Or we can say if we have invested in savings account in the bank or fixed deposits, we have recurring deposits, then the interest received under such type of schemes or such type of deposits, the interest will be coming under this head, that is income from other sources. So these are the 5 heads in which the incomes of India are categorized. So the next slide will give you the meaning of gross total income and taxable income. Now what is gross total income? Gross total income is the aggregate of income under all heads before deductions. That means in the previous slides I have already told you there are 5 heads, that is income from salary. So gross total income will be the income from salary plus income from house property plus income from profits and gains from business or profession plus income from capital gains, and lastly income from other sources. So the aggregate amount of all the incomes under this 5 head is known as gross total income. Then from this gross total income, if we deduct the deductions under chapter 6a, it will be explained later on in my later presentations, but for now you have to know that there is the deductions under chapter 6a, and in this chapter 6a the sections were included from 80C to 80U. So all those deductions you can claim under Income Tax Act, and if from gross total income these deductions are deducted, then it will become total income. And from total income, if we'll deduct again the exemptions and deductions, that will be the final income, or we can say the taxable income in which we have to pay the tax. Okay, so gross total income is the aggregate income of the 5 heads, and from that if we deduct the deductions under chapter 6A, that is from 80C to 80U, then that will be defined as total incomes. And taxable income is the income in which we pay the tax after claiming all deductions and exemptions. Is it clear? Then we have come almost end of the slides, that is assessment year and previous year. So these two are the main concept under which the income tax is based on. So what is previous year and what is assessment year? In my opinion, if I would like to explain, then these both are the financial year. This both are financial year, any financial year comprising of a period of 12 months starting from 1st April to the 31st March of the next year. So the basic difference between these two are, in previous year the assessee earns the income. The income is earned in that year, and when that financial year is completed, then in the next year the assessee is liable to pay the tax, or we can say in the next year the income of that assessee is assessed and taxed. So for example, if I have earned suppose rupees 5 lakhs in the financial year 2023-24, then I will pay tax in that 5 lakhs in the year 2024-25. That means what? 23-24 is the previous year and 24-25 is the assessment year. So previous year always precedes the assessment year. On the other hand, assessment year always succeeds the previous year. So these are the main concepts of income tax which you have to know. Then only you can go further. So coming to the last slide. So from this presentation, we have understood the key concepts of income tax which are essential for compliance, the heads of income which helps to classify the sources under which we are earning. Then again we have learned the definition of assessee. Actually in Income Tax Act in India, who will pay income tax in India? That is clear. And exemptions and deductions are always essential for effective tax planning. If we claim exemptions and deductions, then that is known as tax planning, and it is within the four corners of law. And on the other hand, if the deductions and exemptions are not claimed, and by any ways we have manipulated our income by reducing it, then that will be go for tax evasion or tax avoidance, and it is not ethical. So tax planning always requires, effective tax planning requires exemptions and deductions, and it is always stays within the four corners of law, and it is long run, it is not short run. Okay, so from this presentation I hope you have understood all the basic concepts of income tax. With this I am concluding. Thank you.